All right. According to the clock on my computer, it is 3:02, and out of respect for everybody's time, we're going to go ahead and get started. We do expect there'll be a few participants that are still joining us here in the next couple of minutes, but wanted to thank all of you for taking some time out of your Thursday afternoon to join Cliff and me for this 2024 market review and 2025 outlook. Cliff and I have had a lot of fun preparing for this, and hope you enjoy some of the material that we're going to be providing. For those of you who do not know me, my name is Phil Daniels. I'm one of the advisors at Brand Asset Management Group, and Cliff Aque is our investment analyst. During our conversation today, we're going to share a variety of data points and really try to help you have a pretty good understanding of what happened in 2024 and what seems to be a reasonable set of expectations for 2025. This isn't intended to be a prediction. I'll share with you early in the presentation some forecasts for some other market prognosticators, just so you can at least know what some of the experts, quote unquote, are thinking. Cliff, if you wouldn't mind, why don't you go ahead and jump to the next slide? One of the things that was important for us to communicate to you today is everything you hear from Cliff and I are our opinions, and they are not necessarily reflective of the Brand Asset Management Group. Also, none of this is intended to be tax or legal advice or specific investment recommendations. But at any rate, if you have any questions or would like to talk about how any of this applies to your specific situation, obviously, one of the advisors at our firm would be more than happy to have a conversation with you about that. So with that, I wanted to start before we talk about predictions for 2025, this is a slide that just shows you what the predictions were for 2024, and they were wrong, plain and simple. We actually had a half dozen or more that were expecting no return or a negative return in 2024, and some of those forecasts came from very sophisticated large firms. There were a number that were positive, but none of them were even remotely close to what we experienced. S&P 500 was up 23.3% in 2024, outpacing its historical average by a full 10 percentage points, with that average there at 12.3. So I shared that with you just as a benchmark because I'm now going to transition into the predictions for 2025. And I'm going to go out on a limb and say they might be every bit as wrong this year as they were last year. So don't read too much into this. But I do think there's something to be drawn from the fact that there's a general agreement amongst all of these forecasts for 2025 that the market's going to go up, with one exception. Stifel actually did not have a point. There's a little asterisk next to Stifel, and I know the footnote might be hard to read on your monitor. It basically says that the forecast of 5,500 is just picking a specific point, when in fact the true Stifel forecast is mid 5,000s. So give them a little grace if it's 56 or 5,400. But everybody else, from where the market is today, right now the S&P 500 is at about 5,950, 5,952, somewhere in that area. Everybody else is generally saying, hey, I think it's going to be a decent year. And I went ahead and crunched some of the numbers just so that you would have it for those forecasts that are in and around the 6,600 level, which there are several that cluster around there. That would be about an 11% positive return from where we are right now. Those that are up at 7,000 are looking at 17.6% return for the year. And good old Oppenheimer up there at 7,100 leading the pack. That's a 19.3% return from where we are. So Cliff and I had a little discussion about what we think. We both think it's going to be a positive year. I'm maybe just slightly more bullish than is Cliff. And the thing that I want you to take away from this is less the magnitude of the positive forecast and rather the unanimity around the positive forecast itself. So before we talk about the things that are likely leading to those conclusions, we want to just go ahead and take a brief look at 2024 as a year in review and point out some of the things that were pretty consistent with what we saw in 2023. One, very, very strong year for markets. The S&P 500 was dominated by growth names. Growth outperformed value by a full 20%, roughly 20%. Mid caps and small caps had a good year. It just doesn't look like it in comparison to large caps. They were up, 11.5, 14%, small and mid respectively. We continue to see the U.S. markets outperforming international, and a lot of our commentary today is going to focus on the U.S. market and the U.S. economy, given that's where we live and that is where the majority of our client investments are located. But we are going to have a few comments towards the end about the international markets. And the bottom line up front is we still think it's incredibly prudent to be globally diversified, despite the fact that for a number of years now, the U.S. market has been beating the tar out of international. That isn't always going to be the case, but it was yet again in 2024 with very modest returns coming out of the international markets. Real estate, very modest return there as well. This is public real estate in the U.S. And then fixed income had variety of returns anywhere from 2.5 or maybe even a little less than 2.5 for some bond types, all the way up to 8.2 for some of the higher risk, specifically high yield fixed income. Interestingly, what we saw was short maturity bonds outperformed the intermediate bonds, despite intermediate having a little bit of a yield advantage. That was because of some of the interest rate movement that we saw in 2024.
I would add, Phil, that the international was doing about the same. It was up over 11, 12% until the fourth quarter when we saw international markets fall 8%. So it was holding its own for 3/4 of the year.
A great comment, Cliff. Thanks for throwing that in. And that is something to be cognizant of. These asset classes can make sudden moves. Cliff and I have a lot of fun preparing for things like this, and we get to talk about what has happened. We get to talk about forecasts, and we get data from firms all over Wall Street. And this was a slide that I thought was particularly valuable, if not too busy. And so there's a lot of stuff on here for any of you who are interested. The Taylor Swift Eras Tour ended in the fourth quarter, and that's highlighted here. I don't think that had a significant impact on the S&P 500. But interestingly, that tour was a significant economic factor around the world. So that's why it's on here. We highlighted a few things in red that we thought were maybe significant inflection points or just things that occurred when the market was making a move one way or the other. One, around April, the annual inflation rate was 3.5%, came in above expectations, and you saw the market dipping after having had a really strong year. I will point out, if you look to the far left of this chart, you'll see 3 red dots, maybe 4. I can't really tell how many there are in early January. Those were the lows for the year. And once we got past the first week of January, I think it's Katie bar the door. It was pretty much nothing but higher. There was some volatility intra-year, of course. But interestingly, there are a lot of green dots on this chart. There were 53 all-time highs for the S&P 500 in 2024. And one of the things that I point out is, well, if the market just hit an all-time high, it doesn't have to do very much to hit a new all-time high. It just has to go up a fraction of a percent. And so you get kind of this one after another during a bull run like we saw in 2024. We did highlight, obviously, there was an assassination attempt on what was then candidate Donald Trump. Obviously, he survived the assassination attempt, but that was a factor that did actually seem to have an impact on markets immediately after that. And then also towards the bottom of that fall off, sometime around August, we got 2 important data points. Unemployment claims came in lower than expected, and inflation came in below 3% for the first time. And that really prompted the run that really carried us through to December, when there were some factors that started to cause people to take a little bit of profits coming into year end and really start to evaluate where is the market at this point, where's it going for 2025.
I think it was the Eras Tour, Phil. And that's probably why the Stiefel analyst is bearish because he's a big Swiftie fan.
Very possibly. So on this slide, basically what we did, and we've had two phenomenal years for large stocks in the US. The S&P 500 was up 26.3% last year, up another 25% this year. I think there have only been a handful of times, I think four, where you had back-to-back years of 25% or greater over the last several decades. This looks at every time we had back-to-back positive years of 20% or more since 1950. And there are a number of them. And the point here is that oftentimes those back-to-back positive years are in fact followed by yet another positive year. There are only two exceptions to that out of this data set. All of the others were positive, and it creates an average positive return of 12.3, and the returns were positive 75% of the time.
And Phil had asked me what the average return was since 1950 before we started this, and I didn't know the answer to that, but I did think it was remarkable that the average 12.3 for these 8 periods it was exactly the same as the first slide Phil showed you, which has the average since 1926 of 12.3. So same exact number.
It was kind of uncanny that it's exactly the same. This data set just shows you that we've gone, as of the end of the year, we've gone 579 days without a 10% correction. And that's a little bit extraordinary, but not unprecedented. It doesn't mean that we absolutely have to have a sell-off in the immediate future. There are a number of cases where we went twice as long or more than what we have. 579 days is a little over a year and a half. And so to go 3 years or even 4 years without a 10% correction can happen, but it's pretty uncommon. And I would say, even if looking at other sets of data, what we can look at is that it's not at all uncommon for there to be a peak to trough decline for a year of maybe about 14%. That's very standard. We just haven't had that for about a year and a half.
And before we show the next slide, Phil, I wish we could do like a poll, but if anybody wants to throw in the chat box how many times they think the market has declined more than 20% in a year since it's 1929, I think is what the year we have there. So it does include the Depression. 26.
Yeah.
So if anyone's brave enough to throw it in the chat, or if they want to throw in how many times they think it's returned more than 20%, because that's what the next chart is going to show us.
That's a good point. And forgive me, I neglected to mention that any and all questions should be entered into the Q&A. At the bottom of your screens, the Zoom features a Q&A box. If you have any questions for Cliff and I as we go all along, go ahead and enter those. But as Cliff said, if you want to take a guess, since 1926, you can guess either how many times we've had less or had a greater than 20% negative return, or how many times we've had a greater than 20% positive return. We'll show you that in just a moment. I've got a question here saying, is 10% relevant when you're dealing with a much higher stock market level than past decades? It's an interesting question, and we'll show you some data on valuations and how that actually is priced in the market. And 10% is relevant, I would argue. Think about it from a portfolio return, whether you have $100,000 invested or $1 million invested or $10 million invested, 10% is still a relatively significant component of whatever that is. So admittedly, 10% is different of 600, but for indexes, and you're going to see as we go through our presentation why we feel like the market is poised for a potentially positive year in 2025 based on some economic factors that we're going to look at. So, Cliff, I don't have any guesses. Why don't you go ahead and...
That's okay. It would have been more fun if we had a poll in there, but I was always just surprised by it. This chart. Just surprised me when I've seen it, and every time I see it, I'm like, oh yeah.
Yeah, and basically what this shows you at an aggregate level is 73% of the time, or 74% of the time, I should say, 73 of the years since 1926, which is 74% of the time, it has been positive. Only 26 years have been negative. But if you look at it, the magnitude, the relatively small number, 6 years have had a loss of 20% or greater versus 38 years have had a gain of 20% or greater. And certainly that's the name of the game with investing. We build portfolios with an acknowledgement of the long-term realities of being an equity investor in publicly traded companies. And so this is what that data really tells you over a pretty long period of time. The next slide we have is we have had tech leadership, and it really was 2024 was all about the AI trade, artificial intelligence, and the companies that are benefiting from that. Companies like NVIDIA. And so, you've seen a significant level of outperformance, growth versus value. And what this chart tells you is when value has underperformed growth by 25% or more, which was accomplished in the third quarter of 2024, the forward-looking returns favor value, and over a full 12-month period of time by a fairly wide margin. That's not a prediction that it's going to happen. It's an encouragement that while you can look at the delta between growth and value and perhaps be a little frustrated that value is holding back what is otherwise a pretty astronomical return, that is something that does eventually revert. And when it does, you could have a meaningful level of outperformance from value. Again, not a prediction that that's happening today. There was one point in 2024 that it appeared that rotation was beginning to take hold, but it didn't get traction, and it kind of undid itself. So we'll keep watching for that, but don't lose hope. Value could, after this magnitude of outperformance by growth, value could have its day in the sun sometime in the not too distant future. So we're going to shift and talk a little bit about some of the primary drivers for the market, both in 2024 and as we look forward to 2025. And certainly the Federal Reserve and how they manage short-term interest rates is going to be a major component. I'll remind all of you, the Fed has a dual mandate, which is to say that they are focused on achieving full employment. So they're looking at a lot of the employment data, and they're looking at controlling for inflation. And we've been hearing a ton about inflation ever since it peaked at 9.1%. But the Fed does have that dual mandate, and sometimes they get conflicting data. They get data that makes them think that the economy is strong and that it can endure some elevated interest rates. But then they get some other data and they're like, well, now, wait a minute, maybe there are some signs of weakening. And watching the employment data, there have been a couple of periods where we got some data that was a little bit unexpected, and either showing more resilience. There was one point where we thought the labor market might be softening a bit. But all of that feeds into what the Fed is doing. And the thing that I really like about this chart is the far right side of the chart. You see the projection both from the Fed themselves at year end, or for the year end for the next couple of years. They do expect the Fed funds rate to continue to fall. But the market doesn't quite buy what the Fed is selling. The market is a little bit more hesitant to believe that the Fed will lower rates quite as quickly as is currently being broadcast. I will point out that little purple dot, though, at 2.9 is still the FOMC's long-run projection, and eventually that's where they hope to get to.
If we looked at this chart a year ago, Phil, those lines would be flipped. The market was well below where the Fed was, and that gray shaded area there, that's kind of where those expectations have gone over the last year. So they've gone all over the place.
But not only have they gone all over the place, but they continue to react literally with virtually every data point we get, not to include a data point we got today that we'll talk about in a couple of minutes. So this is just a picture of the yield curve, which is a graphical representation of the yield for varying maturities of of government debt issues. So T-bills, notes, and bonds. And so the point here is that we finally have gotten to an uninverted yield curve. For the past couple of years, we've been dealing with an inverted yield curve. You might even remember at one point it was supposedly a harbinger of the recession that never materialized. But now we're back to a more normal slope, and we're looking at the progression of higher yields from the 2 to the 5 to the 10 and ultimately to the 20 and 30-year periods. A lot of focus has been on the 10-year, and we'll look at the 10-year yield in just a couple more slides. In fact, I think maybe we even look at it on the next slide for 2023. And you'll remember, if you listen to Cliff and I give this presentation in January of 2024, we spent a lot of time talking about the yield curve and what the treasury yield, the 10-year treasury yield specifically did in 2023. And it was a crazy year of ups and downs with moves that are not commonly seen in the 10-year treasury. But you ended 2023 at pretty much where you started 2023, slightly higher, but it was a wild ride to get there. Now, 2024 was a similar story, another roller coaster ride, admittedly in a tighter band, which is good to see, a little bit more normal from that perspective. But just into the end of the year and even at the beginning of 25, we saw that 10-year treasury yield spike back up. Cliff, if you can move your mouse and maybe move it around a little bit near that 5% area, we went from 4.5 up to almost 5% very quickly. And only with the CPI data coming in today did we see that come back down. We're about 4.6, 4.65, I believe, at this point in time. As the market is trying to read every single data point, they're trying to read into those data points to ascertain, is the Fed done? Have we gotten all the rate cuts that we're going to get? At one point, just a couple of weeks ago, there was dialogue around, hey, is the next move by the Fed potentially an increase? And that was driven by a concern that, the economy is proving to be pretty darn resilient in here. And if inflation doesn't move the right direction, the Fed could make getting inflation under control a higher priority, feeling very comfortable with what the labor market data was showing. Fortunately, this CPI print today, particularly the core CPI, is kind of calmed the market. Or I guess maybe that was yesterday where we got the spike. We saw the market respond favorably, and that really was kind of a relief from that issue very specifically. I would caution you, as 2025 unfolds, keep an eye on this 10-year treasury. When it gets up and it's bumping against 5%, that is a little bit of an issue for equity markets. And what we've seen is an inverse relationship between treasury yields and equity prices. That's probably something that'll persist in 2025.
Yeah, I will say the 5% still seems like it's fair given inflation expectations and growth, GDP expectations, and both of them being called 2 to 3%. Well, 2 plus 3 is 5, so 5% seems possible, but it wouldn't make me terrified. But to your point, something to watch.
Right. If you want to talk a little bit about what happens after we cut rates.
Yeah, so I'm not sure. As Phil just said, we're not sure that we're done cutting yet. There could be another 1 or 2 here this year. The point of this slide is to say, what's the benefit of staying in cash after the short rates are going down? So yes, you can get 4 to 4.5% call. You're not going to get this 7.7% average. Obviously, we had some much higher rate environments back in the day. You can see we're most likely in the soft landing area. If there's a chance of a recession still, even then, if you call that 4% for cash, it still benefits you to kind of move out into riskier asset classes after a rate hike. So in all these cases here, it's just showing positive returns, in stocks, and there'd be positive returns probably in the fixed income sectors as well. This just focuses on equities rather than just staying in cash. So I think that's kind of it bodes well for risk assets after a rate cut. And so to Phil's point earlier of the dual mandate of price stability and full employment, what the Fed's going to do next really depends on those two things, which I would we dig into those.
Yeah, and so kind of digging a little bit deeper into inflation, this shows you inflation over a long period of time, going all the way back to the inflation spike of the 70s. And sometimes the thing that really helps get inflation down is a recession. This has been kind of an anomaly or an extraordinary period where inflation did spike. It got up, as I mentioned earlier, up to as much as 9.1, and it had been brought down in that kind of Goldilocks soft landing scenario that Cliff just mentioned. Um, we have for a while now been speculating at some point, might the Fed actually accept the fact that a targeted 2% isn't necessary? And when you're at nine, getting back under three feels great. And to have a lot of angst because you're at 2.9 or 2.8 or 2.7 instead of at 2.0, I wonder how much tolerance there might be. And I think the biggest concern out of the Fed is, hey, if we lower rates and we have a resurgence in inflation, then we could be kind of a dog chasing its tail, and we don't want to get into that position. So I think they want to be very, very careful. I think most people would tell you that they are still at a restrictive level of monetary policy currently. And so that tells me they're still more concerned about inflation than they are about unemployment. So at any rate, we continue to watch every one of these data points with great interest. The thing that really is interesting to me is to look at the underlying components. And this was one of the things that I thought was instructive in the release this week is if you look at this, there energy, shelter, dining, and recreation, auto insurance, core goods, and food at home are the components that make up the CPI data. And of course, you'll hear about it all the time. They look at core CPI, which excludes the food and energy components because they're a little bit more volatile and they can move the numbers around. But if you look at these data points from 2020, I'll call it mid 2022 on, a big piece of it has been shelter, the dark blue portion of these bars. And Cliff and I were talking about this, and I do think there's a little bit of a lag to the shelter. I think it happened as inflation was building. If you look when inflation was hitting 7.5, 8% in late 21, early 22, the shelter component hadn't really surged to its highest levels, which it didn't get to until January of 23, when the overall CPI number was on its way down. So you kind of see that it lags some of these other indicators, or some of these other components, I should say. And I think what we're seeing right now is we finally have that shelter inflation number moving in the right direction. It's just doing it more slowly than what Chairman Powell would like it to, based on his comments in the December coming out of the December meeting. But shelter was up 4.6% in this most recent reporting period, which is the lowest it has been since January of 22. That, I think, gives the Fed some encouragement that, hey, it's heading the right direction. If it stays on that trend, we might be able to get to where we want to be. So then the other part of their dual mandate is stable job market. And this is one that's been really interesting is we've gotten some conflicting job data in different periods. And right now we're looking at about a 4.1% unemployment rate. And wage growth has been very much kind of on par with its long-term average. So I think the Fed should feel pretty good about the job market being stable. And I think that's the thing that could change the whole interest rate forecast. If we saw unemployment starting to increase, I think that's where the Fed might feel a little bit more compelled to take their next rate reduction. But if the unemployment rate stays at or a little below 4%, I think they can feel very comfortable keeping rates where they are, continuing to battle inflation as the primary area of focus. So keep watching the employment data. That could give you an idea of when the Fed might be a little bit more willing to cut rates, maybe more than one or two times that are currently projected.
We had a question come in, Phil, on the inflation part before we leave it, and just whether the shelter is considered home sales. And it's actually considered owner's equivalent rent. So they basically just survey homeowners as to what they would could charge for the home. So it actually is a measure of what they think the rent would be.
Yeah, and rents as well. And I know I've got a daughter who is still renting an apartment, and she keeps me apprised of the rental rates that she's experiencing, at least. And I would tell you at least the anecdotal information from her and the data that I've seen in some of the other research that we've seen. Those rental rates were surging a year and a half ago. They're softer now than they were 12 months ago. And I think that is consistent with this data point that we're talking about.
Yeah, I agree.
Here's just another set of data that really helps you see the full complexion of the labor market currently. You may remember a couple of years ago, Chairman Powell kept talking about the number of job openings relative to the number of unemployed individuals, and it was running at double. And he was not at all happy with that ratio. And so the chart to the left of this page shows you how much the job openings have declined from over 12,000 to now somewhere around 7,400, 7,500. That's healthy. That's good. That's helping the Fed believe that some of the inflation that was coming from wage pressure is abating. And you also see a softening in the labor market without the unemployment rate spiking in the JOLTS quits numbers and layoffs. You're seeing a little bit of a pickup in layoffs here recently, but fewer people are quitting jobs than what they were when there were 2 job openings for every person looking for a job. And that's a much, much healthier labor market.
Yeah, and I put it in the quarterly commentary, but the opening per person is now below pre-pandemic level, so it's under 1.25. So even though it doesn't look like it on the number of openings there, because there's more people looking, I suppose is the reason. And that layoffs, if you look at just the historical average, still well below that. So
Right. Good point. Um, so this is, I think it's fascinating. You know, we came through COVID, and I still hold my personal opinion is that we're still unwinding the effects of COVID and economic shutdown that we had, and then the reopening of the economy and the service sector outperforming uh, or I'm sorry, rather the goods outperforming service coming out of COVID, and then service trying to play a little bit of catch up more recently. I still don't know that we've quite hit our equilibrium, but I'll be darned if you don't look over the last 23, 24 years, if the growth of the U.S. economy isn't pretty much on trend, a little above trend actually at this point. And the most recent economic data we've been getting shows that the U.S. economy continues to grow above trend line levels. That's a reason for optimism and a reason for equity values to be perhaps a little bit more extended, because the expectation is that earnings growth will continue. And in fact, well, Cliff, you want to talk a little bit more about economic growth and the makeup of GDP?
yeah, sure. And so as you can see, the biggest chunk of GDP is the consumer, so over almost 68% there, and the government. So it's helpful to look at kind of the health of those two pieces of the economy. And we all know the federal finance situation is not pretty. So it's at least we have Department of Governmental, what's the East Efficiency, Doge, set up. So maybe we'll see some changes to this. The This is based on the Congressional Budget Office, CBO, and their estimates, and you can see that they don't look good. And these do not take in Tax Cuts and Jobs Acts being extended. So JP Morgan did a little work here to show if that gets extended, which we would expect it would with a all Republican administration, the effects are even worse, in terms of the future. I should apologize too. My voice is going to be a little strange, and I'm just finally getting over COVID. So I apologize to everybody it's also my excuse when I make a mistake, COVID brain. So anyway, federal finances don't look great, but everyone knows it. So we'll see if something changes there. But when you look at this absolute number, $7 trillion looks like a lot. Deficit of, almost over 1.8 trillion. then you look at the consumer, and the consumer has a net balance sheet of over 160 trillion. So like it's just huge, right? We could just take out the deficit with the consumer alone, but not that we're going to do that. But anyway, this just shows just how strong the consumer is. So really great balance sheet, 9 times liabilities. That's pretty excellent. So you can see in the charts on the right hand side, rising rates has definitely affected the consumer with debt service ratios coming back off a 40-year low during the pandemic, but back to a very reasonable level. And we have seen delinquencies start to pick up back to kind of pre-pandemic levels, or even a little higher than that, which is a little concerning. Although we've seen those really on kind of the lower earners, the lower end of the economy, who's seen more stress from rising rates. So, if you look at those lines closely, you can see they've kind of leveled off in terms of delinquency. So, something to watch, but nothing that is, a screaming concern as of the moment. And then,
Yeah, and I'm just going to project a couple of things here. I
yeah,
realize that we're about two-thirds of our way through the hour that we allocated to this. And I want to remind everybody, if you have any questions, you can enter them in the Q&A box on Zoom, and Cliff and I will try to answer them or circle back to them at the end. And then while we're talking about consumers, just keep in mind that's two-thirds of GDP. And if GDP continues to run above trend, it's largely on the back of a healthy consumer. To Cliff's point, though, it is gratified. The lower economic portion of our country is actually struggling with the still elevated prices, more so than the top quartile or top 50% even.
yeah, and the top quartile makes up about 40% of spending. So, health of the top two quartiles is more important to the economy. Health of all the quartiles is important to all of us. But and then corporations are strong. So earnings growth, last year a little over 9% or about 9%, and projected to be higher the next couple of years. And then if you look at profit margins, we're at kind of near all-time highs in terms of profit margins for the S&P 500. So that looks very strong. Now, here's the part where we get a lot of questions. Go ahead, Phil. You have some to add?
Yeah, I was just going to say with a 15 and a 13% earnings growth projection for the next 2 years, that's a pretty strong indicator. Now, again, that doesn't mean that is what will happen, but that's a pretty strong support, even for some extended valuations, which we're going to talk about momentarily.
Yeah, and so the way to get out of these extended valuations is either you earn your way into it or the price declines, right? So that's why we're comfortable saying, we think the market still has room to go because despite these elevated, PE numbers on the surface, the earnings still look pretty good going forward. So I think, the market's a forward pricing machine, so it should be pricing this stuff in. But we think that there's positive things, and so let's look at this 22.2 number here, near recent highs, and kind of think about why. So here is concentration in the S&P 500. We are at all-time highs for the 10 holdings. Back during the bubble at 27%. Today we're at almost 39%. So the top 10 has made up a huge portion of the S&P 500. And if you look at this little inset box here, it shows you in 2024, the top 10 made up almost 2/3 of the return of the S&P 500 index. And then the fourth quarter, over 150% of it. Large cap growth was up 8% in the fourth quarter alone. So, just a tremendous bounce back in the fourth quarter, or not bounce back, but rise up. So if we take out, so the average PE of those top 10 is 29.3. So that's, a significant amount of addition to that 22.2. But if you take an equally weighted index, so that still includes your high PE companies, but it makes them the same size as everybody else. So this is the 500. Everybody makes up the same amount of the index. The current PE ratio there is 16.3. So only slightly above the historical average of 15.4, which makes earning your way out of that look more attractive. The other thing, we don't have a slide on it, but earnings growth of those top 10 was immense. Like they went up for a reason because their earnings were very strong. The actual earnings for the rest of the 493 companies in the S&P 500 were slightly negative. So that is projected to reverse and broaden out. The earnings expectations for the top 10 are expected to actually come down from where they were, while the earnings expectations for everybody else are expected to go up. So that leads us to think there could be a broadening out of performance from what we've seen. And this chart's a little hard to explain, so bear with me on it. But essentially, this is taking the regular S&P 500 versus the equal weighted S&P 500 that we just talked about. And when you see this zero line here in the middle, any dots above it is when the equal weight has outperformed, and any dots below it is when the cap weighted regular S&P 500 has outperformed. You can see when the index starts to get more concentrated in the top 10, equal weighted has outperformed over the trailing or the next 5 years in all these cases. So I think this is a pretty compelling chart to say, well, we don't know where we are after 2 years of really strong performance from the Mag 7. Maybe we'll have a first year where the S&P outperforms over 5 years versus the equal weight. But this gives us a lot of hope that we could see some broadening out into the other 493 and even small cap and mid cap and international potentially. What are the risks? I think really policy is kind of what we're first and foremost in our minds is one of the risks. This chart here is taking a look at Trump's first administration, and that time around, Trump kind of led with deregulation, and you can see the market responded favorably with the S&P going up, from 2,300 to 2,900, and then the trade war started, and you could see there's a lot of uncertainty when that happens, and that's so kind of taking what's going to happen this time around. I think we could see that be reversed. So there's more trade tariff talks at the start of the administration, and then maybe some the more deregulation stuff being able to be pushed through later in the administration, with the House and Senate. So I'm not saying this is a foregone conclusion, but saying we could definitely see some choppiness, come even starting as early as next week with some executive orders being issued, but we just don't know. So just to be aware that is a potential.
Yeah, and I read an article. We don't have a slide for this, but I read an article that in addition to deregulation and tariffs, you're generally going to have a pro-growth agenda, which is commonly good for companies' earnings and ultimately the stock market. But there is also an evaluation that suggests that you might see a more mergers and acquisition friendly environment as well, and you could see a pickup in that activity, which could drive some valuations from that perspective as well. So I'll be really interested to see what M&A activity looks like as the year unfolds.
Yeah, absolutely agree. And then pick up a little bit even in 2024, but it's a very, very low level and a very intrusive FTC and administration. So that'll be very interesting. I thought it'd be interesting to touch on. You've probably heard other people say U.S. exceptionalism. I heard it 3 other times in the last few days after I was working on these. Like, well, I guess I'm not very original, but that's okay. But really, this just shows the U.S. equity versus the rest of the world, the S&P 500 versus the rest of the world, and the next 12-month earning per share. The difference between us and the rest of the world is really why you've seen that stock market performance, outperformance for so long. So we really have had a long period of just great earnings versus the rest of the world. So that one, and then exceptions with the consumer. So after the pandemic, you see sales really spiked up and stayed high, versus that dotted or dash red line, which is kind of the trend that we were on before the pandemic. We're really beating that that bogey. But you can look at the rest of the world. We have Japan, or the euro and Japan down here. They bounce back a little bit, but just not to the same extent we have, and it's not as strong. And part of the reason is deleveraging. So after the great financial crisis, our consumers really delevered. The rest of the world didn't as much as we did, and have, in a lot of cases relevered more than we have. We've been pretty flat, and a large part of this, I don't have a slide on it, but our mortgages back in 2007 were 50% floating rate. Today, they're only 10% floating rate. So mortgage rates going up to over 6%. The average mortgage rate for homeowners is still below 4%, 3.9% here in the U.S. So, it's not good for new home buyers, but for people who already have locked in lower rates, rising rates doesn't affect them as much, at least on the housing part of things. So, I thought that was interesting. And then this blew me away in terms of, if you think, what's next, right? With everyone talks about AI. This is the number of data centers. This is an old number. This is March of last year. So I'd be interested to see when this is updated. But we have over 5,000 data centers. The next 10 are just over 3,000. So really, there's going to be an AI boom. We're really going to see it here for sure. And this productivity is without AI. So if you think about, we've had increase in productivity, after a period of some negative productivity after the pandemic. If we get any benefit from AI here, we're going to be looking more back at that average of 1950 to 2009 of over 2% versus the past decade where it was just above 1%. So I think there's a really good chance that productivity continues to be strong. And we've had fiscal support. So you see these up arrows, that's spending is stopping. The down arrow, spending is increasing. Not saying that's necessarily a good thing for the government, but it does support support GDP and the economy. So there's good and bad, but we do have continued fiscal support. I don't think the new administration is going to be stopping fiscal support. Maybe there'll be some efficiencies, but still clearly spending money. And then finally, monetary support. So, the Fed generally will cut rates, yes, this time to avoid a recession, but you don't see 100 basis points of rate cuts when the economy is growing around 3%. It's really not precedented before. So to think about that, cycles tend to lead to inflections a couple quarters later. So we have tailwinds for growth because we've just seen rate cuts on top of strong GDP. So I don't do you have anything to add to that, Phil?
No, I think that's the right way to think about it is, we've got a lot of factors contributing towards continued growth of the economy, continued profitability for companies, which ultimately then supports the prices. I do think that you have to be cognizant of the valuations, particularly for those large tech companies that have made their move over the last couple of years. But I've been waiting for a broadening out of this rally and would not be at all surprised if that began to materialize in 2025. It's harder and harder for some of these big tech companies that are leading this AI initiative. Even the comments that you heard from NVIDIA's CEO last week, I think it was, that he made comments and the stock weakened a bit in response because he has a fantastic story to tell 1, 2, and 3 decades from now. Wall Street doesn't care. Wall Street wants something 1, 2, and 3 quarters from now, and the time frame didn't quite match, and so they plummeted the stock in the next couple of days. But I'm not telling you NVIDIA's in the doghouse forever because they'll do something amazing and away they go again. But I do think that this rally has a chance to broaden.
Yeah, and a lot of that U.S. exceptionalism has led to the strong dollar, right? I mean, the dollar is definitely, by any purchase parity metrics, overvalued versus a lot of other currencies. But in the face of potential tariffs and just where rates are here, the dollar is poised to probably remain strong for the near future. By the near future, I mean at least the next 6 months. I don't see anything that's going to change that. Do you have any comments there, Phil?
Yeah, the only thing that I would say is, one thing you want to watch is you want to watch the dollar, the strength of the dollar, because ultimately that does have an impact on your non-U.S. returns as a U.S. investor. And so as the dollar is strengthening, it creates a little bit of a headwind. And if we get to an inflection point, the dollar starts to weaken a little bit, that'll be a tailwind to your international holdings.
Which leads right into international valuations being, two standard deviations away from kind of normal. So international, all you need to take away from this chart, these two charts, is that international is extremely cheap. It's partially been cheap for a reason. Again, the earnings have been less strong, but just given where the valuations are, doesn't it takes very little to make improvements to that and have a bounce back, especially again if the dollar shows any signs of weakness, then that'll also reverse those trends.
Yeah, the way I like to think about it is, the U.S. coming out of COVID specifically, the U.S. recovered more quickly than the European or developed Asian markets did. And that has continued. It still persists. And so it doesn't surprise me that the U.S. market has outperformed in that environment. The reality is, for systemic reasons, the U.S. economy may continue to outperform these other developed market economies. That doesn't necessarily mean that the stock market will outperform those stock markets. And the reasoning for that is, how much are you paying for each dollar of earnings that is produced? And that's where this comes in. For those of you who haven't studied statistics, I'll just mention, two standard deviations is saying, we've entered rare territory. This is like a 2.5% probability area that we're currently living in. And when you get to any statistical analysis, if you get into a 2.5% likelihood range of outcomes, you don't usually stay there very long. So again, I'm not saying that the European economies are going to outperform the U.S. economy or that the companies there are better than U.S. companies. I'm not saying that at all. I'm saying you're paying a whole lot less for each dollar of earnings, and eventually global investors are going to see that spread. And to Cliff's point, there's going to be some capital flow that direction, and it's going to push those prices and begin to push it back to a reversion to the mean. This is a chart. We got a couple of questions. There was one that came in a few minutes ago, and I was waiting to answer it until this particular slide. And that was, so as you think about how different parts of the economy might respond to all the factors that we've talked about, do we manage portfolios in a way that we shift to certain asset classes or certain sectors? And so we do and we don't. We really don't make sector plays. And that's probably a good thing because, my goodness, can you be wrong making sector bets? Right now, it's starting to look, with the earnings that were released today and some of the momentum that's been building the last few weeks, it looks like financials might be coming into favor, in part because they're expecting a different regulatory environment, maybe different capital requirements for the big banks under the new administration. But there's some thought that, based on where we are in the interest rate cycle and some other factors, maybe banks are a place to be. Well, I heard people say that 6 and 9 months ago, and they were a little bit early. Getting the timing right on sector rotation is very, very difficult. So no, we do not do that. Now, from an asset class perspective, and it's why I wanted to address it on this slide, this is a chart that I've come to know and love. And really, you don't have to read it in great detail. Just notice that the same color doesn't stay at the top or the bottom for very long. You can look at and the year-to-date slide, or the year-to-date column on this slide, is in fact the full year 2024 data. And you can see large cap was the best performing asset in 2024, as it was in 2023. But in 2022, it was one of the weakest, down 18%. And so you can see things move back and forth, back and forth. The thing that I really wanted everybody to focus on is the white box that kind of stays towards the middle. And that's the benefit of being diversified. You have these things in your portfolio at an appropriate weighting. And so what we're doing is we're looking for opportunities to rebalance, to sell things and take profit from the things that have done well, to put more dollars into the things that haven't performed as well, expecting their day to come. And we believe that kind of disciplined application of a well thought out structure can serve a family really well over extended periods of time rather than trying to make quarter to quarter or year by year sector bets.
I'd add to that, Phil, too, at a portfolio level. And, it might not be everyone might not have experienced it the same way, but as a firm, and this is before me, so I'm not taking any credit for this. You guys did reduce some international exposure for the U.S. and you did go shorter duration and fixed income, which it saved a lot of people a lot of money when rates were going up. So there are times when you can see, yes, we're expecting rates to go up, so let's move shorter duration, and rates did go up. So there are some of those things, but generally speaking, we try to be strategic, but there are times when you can adjust the strategic allocation to take advantage of things.
Yeah. Before we've got two questions. I'm going to go ahead and address these questions. Then I have a couple of concluding comments, and then we'll circle back to any additional questions that any of you might have. Cliff, we got a question about the impact of tariffs on the strength of the dollar. What are your thoughts on that?
Yeah, so what a lot of countries will probably end up doing, which we saw China do in the last round of tariffs, is devalue their currency. So then that pushes the dollar up even more. So the last time around, we had those with the 15% tariffs on China, 10%, whatever it was. Chinese government devalued the yuan by 13%. So that's why it kind of will push the dollar probably higher. It's at some level, just as and people try to just account for those those higher prices and make it easier on their own country. So yes, that probably will impact the dollar.
And I think to a certain extent, it depends on what the reaction is to tariffs. So your point about how other countries might manage their currency is a valid point. I think maybe does it turn into a full-blown trade war where other countries are increasing tariffs on U.S. goods? That's going to be a really interesting situation to watch. Some of you may have heard me make this comment before, but I read an article several months ago as there was debate about what the impact of tariffs might be on the economy and on global trade. And a gentleman wrote an article that I read that suggested, be a little bit careful, because if Donald Trump imposes tariffs on a country, but that then drives them to a negotiating discussion, the net result could be that tariffs are temporarily imposed to negotiate a reduction in the tariffs that currently exist on U.S. goods. And I'm not saying that I think this will happen. It's just recognize that it's a possibility that we could end up with freer trade as a byproduct of temporarily imposed tariffs rather than we impose tariffs and they're there for the next 4 years. So, I don't know who's going to be right. I don't know enough about global trade negotiations to really have much of an opinion. I just thought it was an interesting perspective. And that drives me to a broader point that I wanted to make sure we made today. And that is, as Cliff mentioned earlier, the market are a forward pricing entity, which means the things that we know today doesn't really influence the prices of assets nearly as much as the things that we expect in the future. And as we move through life, every once in a while, we get a new data point that was not expected, and that's when the markets really have to react. And so I think that if Trump's inaugurated on Monday and he starts to have some executive orders, he starts to impose some tariffs or do whatever it is he's going to do, there will be a reaction to those actions. And it's the reaction, I think, that's going to really define what are we dealing with from a market environment as the year continues to unfold. And I'm a big fan of keeping your eye on the unexpected things that unfold to give you a new data set that you have to incorporate and that the market in general incorporates into its expectations. Cliff, you did a wonderful job of walking through U.S. exceptionalism, which leads to a very logical question from one of our participants today. that says, why would we not cut back on our non-US investments for at least the next 1 or 2 years because of all this exceptionalism?
Well, as soon as AI makes a time machine, we can go back to 2008 and just put all our eggs in the U.S. and not look back for 15 years. But we don't know that that will continue. I mean, yes, it looks like it's to be strong, but then you look at that valuation chart at two standard deviations difference, and something's got to give. So it almost started last year. We saw internationals outperforming the U.S. for a tiny tiny period of time, and then it reversed. So there's a chart that we could circle back with that shows just how much international outperformed the U.S. up until that period. It was tremendous. So there's periods where one works and better than the other, and you want to have exposure to both. So,
yeah, well said. Well said. So one of the things that I wanted to leave you all with today, we're wrapping up here. If you have any other final questions, please enter them in the Q&A box. But on this next slide, we just kind of summarized a handful of things that we would encourage you. Keep in mind that there's a lot of innovation optimism. And a lot of this is being fueled by AI. I mean, there is AI as a standalone issue that is transforming the way we do work. Some industries more than others, but there's a lot of efficiencies that's being gained. And some people are comparing AI to the Industrial Revolution or comparing it to the technology revolution. And so we're looking at a whole new ability. And if you begin reading a few articles about what it is allowing to happen, these are some of the bullet points that I've taken away from things that I've been reading. It is going to transform the way pharmaceutical and biotech research is done. We're going to have new products coming to market that are more customized, more tailored. I read a story of a gentleman, and forgive me, my details might be a little foggy. It's been a while since I read this. A gentleman who had cancer, his oncologist had treated him with several different chemotherapy protocols that would be effective for a season and then not. And the cancer kept coming back and coming back. And finally, the oncologist was out of options. He's like, I don't really have anything else for you. And it was at a point that they were going to be moving him to palliative care, and it was his end of life. Well, they submitted all of his data into an AI agent, and it said, have you tried this? And it was this novel treatment protocol that put him into remission. The ability for artificial intelligence to digest incredibly huge volumes of data and to come up with specific solutions to specific problems is going to change the world we live in ways that I'm very excited about. And I'll connect all of this, what it means from an investment standpoint in just a moment. But from a quality of life standpoint, in terms of what the future for our children and grandchildren looks like, it is beyond our imagination. The same thing's true of transportation. And you can talk to me about your discomfort with driverless cars, and I won't disagree with you a whole lot. But the data suggests that they're actually significantly safer. There are much fewer accidents and injuries with driverless cars than with human-operated cars. Driverless cars do not text and drive at the same time. They have more sensors evaluating things. They literally have eyes in the back of their head. And Waymo, which is one of the driverless taxi services that are out there that's been operating in Los Angeles, Phoenix, San Francisco, they're now moving into Miami. They were doing, I don't know, something like 10,000 trips per week. They're now doing like 175,000. The future is actually now. The companies that are doing these things are going to be fantastic investment opportunities as the world around us changes increasingly quickly. There are improvements in energy efficiency. Whether you're talking about better battery efficiency and the ability to hold a charge for longer. Imagine being able to charge your battery in 30 minutes and drive cross country without needing to recharge. These are things that are on the horizon, and artificial intelligence is helping to drive them. Imagine supersonic flight. You may remember the Concorde. There were some issues with the Concorde, but the ability to travel at supersonic speeds is being reintroduced to air travel. Um, Improvements in energy efficiency can take all kinds of different forms, transportation, all kinds of different forms. You're hearing things about SpaceX and other private enterprises. I think I just saw something that Jeff Bezos's space exploration company just had a successful launch within the last 48 hours. We're seeing private sector space exploration, which brings a whole nother level. I read an article about research being done in zero gravity is allowing us to do things that cannot be done on Earth. Specifically, they were talking about growing, I want to say it was a meniscus or something like that, that in the gravity of the Earth's atmosphere, the cellular structure collapses upon itself, but you take it up into the space station, you can grow a meniscus, bring it back to Earth, install it, and it's great. I mean, these are crazy, almost science fiction-like thoughts, and there are countless productivity improvements that artificial intelligence is going to make possible. One of the things that I think is very exciting right now is evolution and the development in energy. There's some very exciting things happening in nuclear energy, small scale reactors, things that just haven't really even been on the drawing board, at least as far as I know. People that are involved in nuclear science have probably known this for decades, but there's a lot of traction taking place. My point, as a diversified investor, and particularly to the extent that you have some private investments in your portfolio, which is something we've been very intentional about doing for our clients over the last few years, you'll have exposure to some really creative, innovative companies, either through the investments that big companies are making, the numbers of mergers and the numbers of acquisitions that companies like Facebook/Meta or Microsoft or NVIDIA, the numbers of acquisitions they make is actually staggering. They'll literally make hundreds and hundreds of acquisitions. They see a promising technology. They don't develop it, they buy it, and then they commercialize it. Or if you're investing in private investments, you can get in on some of these early stage venture capital or private equity investments. And that's another way that you get exposure to this. I'm just suggesting that there's reason for a tremendous amount of optimism about what might be in our future, both in terms of our quality of life and in terms of the quality of our investment opportunities. I think we're just looking at a faster and faster and faster cycle of innovation, thanks in large part to artificial intelligence. Anyway, and I don't say all of that to discount the things that I know all of you are concerned about. And I will share, yeah, there are risks. I'm not in any way, shape, or form suggesting we've seen our last bear market. The market is still a cyclical pricing mechanism. And at some point, we're going to get a negative surprise and we'll see a contraction in prices. We have managed that. Our firm's been around for 53 years. We've managed negative environments countless times, and we're prepared with the strategy to do so on a going forward basis. We strongly encourage you to stay disciplined, let diversification work in your benefit, take advantage of some of these new innovations, and make sure that the allocation that you have is appropriate for your spending and your goals. Talk to one of us, one of the advisors at Brand, about that if you have any doubts. But we do think that there's going to be some catalysts for some earnings growth. And we think the outlook generally is not catastrophic. We've had people say, oh my gosh, look at how far the market's moved. Should we take some chips off the table? We have been, and we do that via rebalancing disciplines. But we don't recommend an extreme shift at this point by any stretch of the imagination. And we are optimistic that when we have this conversation next January, we might be able to celebrate another at least average or maybe even above average year for the S&P 500 and a broadening out to some other asset classes. So I'm looking for any new questions and don't see any. Cliff and I don't have anything else to do the rest of the day. So if you all want to keep firing off questions, we'll be happy to answer them. But you've been very gracious with your time. We hope you've heard something that was at least of interest or food for thought. And we look forward to meeting with you in person at the next opportunity. Cliff, any parting comments?
No, thank you.